Understanding market corrections, definitions, causes, and strategies. In the realm of investing, understanding market corrections is crucial for both novice and seasoned investors. A correction, commonly defined as a decline of 10% or more in the price of a security from its most recent peak, affects not only individual securities, such as stocks and bonds, but also broader market indices that represent groups of these assets. What causes market corrections? Market corrections can stem from various triggers. 1. Macroeconomic factors, economic indicators, interest rates, inflation, or geopolitical tensions often influence market sentiments, leading to corrections. 2. Company-specific issues, problems such as management failures, poor earnings reports, or regulatory scrutiny can lead investors to rethink the value of a company, prompting a sell-off. 3. Market psychology. Emotional investing can exacerbate corrections, where fear leads to panic selling. The psychological factors involved, such as fear and greed, play a significant role in market movements. Corrections can last from a few days to several months, with the average duration hovering around 3 to 4 months. While the immediate impact of a correction may be alarming, it's essential to realize that a reevaluation of asset prices often follows, leading to profitable opportunities for some investors. The mechanics of market corrections. Market corrections might seem frightening to those closely following their investments. A report from CNBC and Goldman Sachs highlights that average corrections in the S&P 500 lasted about 4 months and resulted in an approximate 13% decline. Despite this, historical data demonstrate that markets have a tendency to rebound, making corrections a brief disturbance in the overall trend of long-term investments. Insights for long-term investors. For long-term investors, corrections are less of a crisis and more of a common occurrence in the cyclical nature of financial markets. Significant losses can be concerning, but those who have maintained their positions through corrections typically see the market recover over time. It's important to maintain patience and composure in the face of temporary downturns. However, short-term traders are often the ones who face the brunt of corrections. Sharp drops can inflict substantial losses on leveraged traders or day traders who aim to capitalize on daily price fluctuations. Charting corrections. Analysts can employ various charting techniques to predict possible corrections. By comparing different market indices, they identify underperforming indices that may signal a potential downturn. Essential tools and techniques include support and resistance levels. Analyzing these levels helps to understand where prices may bounce back or fall further. Technical indicators, tools such as Bollinger Bands, envelope channels, and trend lines are used to assist in predicting market movements. Regular review of these indicators is crucial, as market conditions can change rapidly. Preparing for a market correction. Investors can take proactive steps to mitigate the impact of corrections on their portfolios. Here are several strategies. 1. Stop-loss and stop-limit orders. Stop-loss orders trigger once an asset's price hits a predetermined point, reducing potential losses. Stop-limit orders specify a target price and an outside limit to guarantee price execution when triggered. 2. Diversification. Spreading investments across various asset classes can cushion against losses. For instance, bonds often retain value in turbulent markets, and sectors such as consumer staples are less sensitive to economic cycles. 3. Reassessment of holdings. Regularly evaluating your investment portfolio can help identify underperforming assets that may need to be reallocated. Investing during a correction. While corrections affect all equities, certain sectors tend to be hit harder than others. Tech and small-cap stocks. These sectors can exhibit more volatility during corrections due to their growth-oriented nature. Consumer staples. These stocks are generally resilient as they provide essential goods, rendering them less susceptible to economic downturns. Investors may find these corrections a valuable opportunity to acquire high-value assets at discounted prices. However, caution is paramount, as prices could continue to decline. The silver lining of corrections. While difficult to endure, corrections can reset expectations and allow for corrected valuations across various markets. Understanding that these downturns are often temporary can help investors stay focused on long-term goals. The historical perspective. Market corrections are not uncommon. From 1980 to 2020, the S&P 500 underwent 18 corrections, with several resulting in bear markets, indicators of more prolonged economic decline. For instance, the corrections experienced in 2018 saw the DJIA in S&P 500 dropping over 10%, yet they recovered by early 2019, signaling the resilient nature of the market. Conclusion. Market corrections should be viewed not just as downturns but as necessary adjustments within the investment landscape. Knowledge about the underlying mechanics, preparation before a correction, and understanding the factors influencing these events can equip investors with the tools they need for successful long-term investing. By remaining calm, diversifying holdings, and keeping an eye on market analyses, investors can turn corrections from a source of anxiety into a golden opportunity.